Hey everybody, thank you for watching this video. My name is Dr. Brian Winrow. I'm a tax attorney and tax professor, and this is part of my partnership series tax videos. And what I'm going to be talking about in this video is our operating distributions in a partnership. Okay, and more specifically, it's going to be a proportional operating distribution. What that means is it's not a liquidating distribution. So our partnership's still going to be existing. We're still going to have a partner. This partner is still going to be a member of this partnership. That stuff still happens. And it's proportional because the distributions are going to be made based on the proportion of ownership or whatever the partnership agreement says. So that's what we're dealing with in this video. What I'll do is I'm going to give you a basic overview of our distributions, and I'm going to work through two different problems so you can see what happens in your typical operating distribution without any type of debt. And then you're going to see a situation where we're going to have an operating distribution that includes some type of debt relief. Now, as I go through here, I told you I was going to do a little bit of a overview of this. So when you have an operating distribution, there's really three different types of distributions that you can receive. Okay? You can receive things such as cash or the release of liabilities. And then you're going to be able to receive things such as hot assets, which would be accounts receivable and inventory. And then you have all other assets. Okay, so a lot of times when we talk about a distribution, we're talking cash. That's the most common. But it's not the only thing that's out there. Sometimes they will distribute the accounts receivable or inventory or land or equipment, whatever it may be. Okay, so we need to know how we handle these situations. And we have very specific ordering rules, and this is important for you to note. The ordering rules when we go through this, whenever we have a distribution, we have to look at cash first and the release of liabilities. Okay, that has to be the very first one. The second one will be our hot assets. That's going to be our accounts receivable, and it's also going to be our inventory. The third one is going to be all other assets. Now, when we have an operating distribution, we try not to recognize any gain. The code doesn't want us to recognize any gain or loss. Now, the only time that we're going to be able to recognize some gain is if our release of liabilities or our cash in the distribution exceeds our basis because there's no way to defer it. Otherwise, what we're doing is we're going to try to change our basis, especially for the other assets. So that's why we have these ordering rules. Okay, so let's take a look at these rules. We're going to go through the first example. We're going to apply those rules. My first example has three separate individual scenarios. So even though it's one example, you're going to get to see it from three different situations so we can see different types of distributions and understand how they all apply. So let's go ahead and take a look at those. Okay, so let's go ahead and take a look at this. And what we're going to do is we're going to look at three independent scenarios on this. And in each of these scenarios, what we're assuming is that they're making distributions to cash, receivables, and also to our land. So the first one we're going to have is going to be Taylor. Okay, so we're looking at Taylor first. Taylor's a partner here. And what we're saying is Taylor receives a distribution. And these are all different partnerships. So don't think that whatever happens to Taylor relates to Sydney, who relates to Stuart. They're all different partnerships. Okay, so we have Taylor who has an outside basis of $100,000. Now, what the partnership does is it makes a distribution to Taylor of cash of $45,000. It's going to give us a fair market value for receivables of $100,000, but we have a basis of 0. And then what we're going to do is we're going to get land that has a basis of $55,000, but a fair market value of $90,000. Now, in the introduction, what I did is I talked a little bit about how this ordering rules go, right? And when you see these things in problems, like if you're sitting for the CPA exam or if you're sitting in class exam, a lot of times they're not going to order these things for you like cash, receivables, land. It's going to be land, receivables, cash, or whatever it is. You've got to be able to put them in order. But the ordering rule is we're dealing with cash and release of liabilities first. Then we're going to hot assets, receivables, and inventory. And then we're dealing with all other assets, right? Equipment, property, land, whatever it is. Okay, so what we first do is we start out with cash for Taylor. And we're going to say her outside basis was $100,000 and Taylor receives cash of $45,000. Well, when you receive cash, you have to lower your basis and you lower it all the way until a zero, depending on what your distribution is. But we cannot have a negative basis. So what will happen here is we have 100,000, plenty of basis to um, accommodate the cash of 45,000. So we're going to go 100,000 minus 45,000. That means we have $55,000 remaining. Okay. So if we just look at this next step down here, if we just kind of go down, this was our general fact pattern, and then we come over here and we can start to see what's going to happen as far as the solution. And then I just did a summary to make it a little bit easier for you to be able to figure out what's happening here. But if we come down here, we said, well, our basis was $100,000. We took the $45,000 of cash and it came over here to $45,000 of cash, which means our basis after the cash distribution is $55,000. Okay, so right now we don't have any type of gain or anything. We just reduced our basis. It's just a return of our capital. All right, but what's going to happen next? We have receivables. So with receivables and land, what we're doing is we take the basis. The partner is going to take the basis as our general rule of what the partnership had. So here we had a basis of $0. Okay, we had a basis of zero. Well, our partner, Taylor, is going to go ahead and take that basis of zero. So we don't have to reduce our basis because this is zero basis. Okay, so we took a basis of zero in the receivables. Now, what will eventually happen is as Taylor starts to collect those, right? Maybe collects 90,000, maybe collects all 100,000. Well, Taylor's now going to have to recognize gain because her basis is zero and she's collecting 90 to $100,000. So all of it will be gain. So all this is really doing is deferring her recognition. She's eventually going to recognize the gain, which is the difference between her basis and whatever she collects for the fair market value, right? So she's gonna recognize that difference. But because she takes a basis of zero, our basis after we accommodate for cash and accounts receivable is still $55,000. So, what's the next thing we do? Well, we have land, and our general rule is we're taking the basis for all these other assets, land, equipment, whatever it is. So basis is $55,000, fair market value at 90. We don't care about fair market value. Okay? That's not what we're dealing with. So what we're doing is we're taking $50,000 for our land over here. Now, here's where it can be a little bit tricky at times. So our basis after accounts receivable is 55,000. We have enough basis to accommodate this $50,000. So we're going to say, okay, we'll take the 50,000. So we're going to take a basis. Taylor's going to take a basis of 50,000 in the land, and we're going to reduce her basis by $50,000, which was the basis of the land that she received and that she now has in the asset. And that's going to put us to a remaining basis of $5,000. So our remaining outside basis will be $5,000. If we look at the solution here, there was no gain recognized because we didn't have debt or release of liabilities that exceeded our basis. We didn't have we don't have a basis in accounts receivable. They told us our basis was zero, so we believed them. We put it zero. The basis in land was $50,000, so we took the basis in land of $50,000 and we used it here. Um, all of that was 50,000, and then the cash of 45 was 95,000, which means that we had $5,000 remaining for our outside basis. Now, I was getting to something before I backed off it. I said this is where it gets a little bit tricky. Let's say that the basis here had been, say, $60,000. Okay. The basis in the land was 60,000. Well, hey, we only have a remaining basis of 55,000. We know we can't take basis below zero. So what will happen? And we know we don't want to recognize gain or loss. So the code tries to prevent us from recognizing gain or loss. So what's going to happen here is we're going to say, okay. So we have a $60,000 basis in land, and we have a $55,000 basis remaining in our outside basis. We're going to reduce the basis in land to 55,000, and our outside basis will now be zero, but we'll have $55,000 for our basis in the land. So we'll see that with the Sydney or Stewart examples, but I just wanted to kind of let you know how this is going to play out. So let's look at Sydney then. Let's see what we got for Sydney. Another 100,000. They're all going to be 100,000. So we have an outside basis of $100,000, cash of 75. So we know we go cash first, right? We have cash, receivables, and land. Cash. So once we do this, that's $25,000 remaining, right? And that's where we're right here. $25,000 remaining. So 100,000 minus the cash gives us our outside basis of $25,000 remaining. Now, we still have, and we use the same examples for receivables all the way across. Basis of 0, fair market value of 100,000. We take our basis of 0, okay? So that doesn't reduce our basis. What's going to happen is Sydney's now going to have a basis in the accounts receivable of 0. When she collects the receivables, she's going to have her gain. That's when it's going to be recognized. It just deferred it for us. But right now, it's not doing anything to our outside basis in the partnership interest. So we're still at 25,000. All right, but look at this. Our land basis is $50,000. Well, we only have $25,000 remaining. We can't have a negative. This can't be reduce this down to 20, reduce the 25 to 0, and then there's a negative 25. We can't do that. What happens is we're going to now take, instead of 50,000, we're going to go ahead and we're going to take the remaining 25,000. Okay, our remaining 25,000, that's going to be our new basis in the land. And because of that, we're now going to have 0 basis remaining from the outside in our partnership interest. So we have a 0 basis for outside basis. Our basis in the land will be $25,000. So when we sell the land eventually for fair market value or whatever, say it's going to be $90,000, we're looking at, what is it, $65,000 of gain. But right now, we have no gain recognized because the money wasn't greater, cash wasn't greater than our basis. We have 0 basis in accounts receivable because that's what the hot asset basis was. Our basis in the land was 25,000 because after we took out 75,000 of cash, we only have up to 25,000. So we had to reduce our basis in the property. And that means we've used up all of our basis. So we don't have any more outside basis. One more scenario in this set of problems. So now we have Stewart. And look at this. 100,000, we haven't changed that. But now we have some cash. Okay? We have cash. Well, with the cash, what's going to happen is we can take basis all the way down to 0, but the excess, there's nothing we can't change the basis of cash. The excess is going to be recognized. So if we come down here, we have to recognize that excess amount. So here we have some recognized gain of $5,000. This is one of the few situations where you're recognizing gain. Okay, our basis in receivables was still 0. We've done the same thing with Taylor and Sydney. We already know that pretty well. Our basis in land, look at, we still got land. It had a basis of 80,000, fair market value of 90. But you know what? We don't have any outside basis remaining, and we can't take basis to negative. So we have to take a 0 basis in the land because that's all we have remaining. So look at that, 5,000, 0, 0, 0. That's what's going to happen. Okay. So if you wanted a way to summarize this, when you're looking at something like the land over here, what we're doing is we're going to take the lower, the lower of the basis in our land, property, equipment, whatever it is, or our remaining outside basis. Here, our remaining outside basis was 0 with Stewart. Over here with Sydney, our remaining outside basis was 25,000. So those were lower than the 50,000 or the 80,000. So that's why we were taking those. When we looked at Taylor, we said 100 minus 45, that was $55,000. Our basis in the land is 50,000. Well, our basis in the land is lower than our outside basis. So that's why we took the $50,000 basis. All right, I hope this is helping. It's just getting some experience with these problems. You're going to be fine on it. Just continue to look through these problems if you're still not sure. I have one more, and I add some complexities to our next problem. What I do on our next problem is we're going to go through and we're going to add some debt in there, which can complicate things a little bit because we have to worry about how much debt is forgiven. And hey, if the person's already a partner, they own part of that debt, so they were forgiven for part of it. So we have to go through and we have to figure out how that whole process works. So let's take a look at the final problem remaining on this one so we can finish off our distributions. So let's take a look at this final problem. So we assume a Madison receives a warehouse held for an investment as a distribution from the MJS partnership on December 31st, 2027. The warehouse is a fair market value of 300,000 and an inside basis of $180,000 to the partnership. Okay, so we're going to have an inside basis on the partnership of $180,000, right? We better mark that down because our general rule is we're going to be taking the same basis that the partnership had is our kind of initial step. The warehouse is subject to a $150,000 mortgage. Okay, $150,000 mortgage. And Madison agrees to assume the debt as part of the distribution. Before considering the distribution, Madison's outside basis was $420,000. So her outside basis, her basis in the partnership is $420,000. She holds a 40% ownership interest in the partnership, and she has 40% interest in the mortgage debt. What are the tax consequences, including does she recognize any gain or loss? What is her tax basis? And what is her post-distribution outside basis in the MJS partnership? Okay, we can answer this. We have all the information we need. So let's go ahead and take this. We are pretty familiar with how we deal with some of these issues. All we really have now is the complexity of debt put in there, right? We're not receiving any cash. We don't have any hot assets. So that's taken care of. Let's just, if we did have cash and all that, we have to deal with that, but we don't have that in this problem. So what we're dealing with is we're saying that Madison's outside basis is $420,000. They gave it to us. It was right up here. So we know it was already 420. All right. Now she's going to assume those liabilities of 150, right? She's taking liabilities of that $150,000. Well, let's go ahead and put that in here because if she's going to have to pay that back, well, hey, that's a pretty big deal, right? It's as though she's paying it off for the partnership. We need to increase her basis by that, okay? However, here's the issue that we have. She was already getting credit for 40% of that, right? She had a $150,000 liability. So when they took on that liability, she had a 40% interest, right? This is where we're dealing with recourse, non-recourse. She had her 40% interest, so her basis increased by 40% of the $150,000. That's $60,000. So she was already getting credit as a partner for $60,000 of that. Okay? She's no longer responsible for that. So how much did she really take on? Well, 150, which was the full amount of the debt, minus she was already liable for 60 of it. So what really happened is this is the amount, 90,000 is the amount that she's actually taken on that she wasn't already liable for. So we have $90,000. So if she's now going to be paying $90,000 on that liability, we need to increase her basis. Okay. Her basis was 420, and now she's taking on that $90,000. So 420 plus 90 is going to give us $510,000. Okay, so we have $510,000 because she's taken on additional liabilities of $90,000. Now that we know she has 510,000, that's her basis. Well, if her basis is there, and now she's receiving a distribution, and the inside basis on that land was $180,000. We said in the last problem, what we're doing for the basis in the land or the property, it's going to be the lower of the inside basis, the basis the partnership had, which is 180,000, or Madison's basis in her outside basis, which is 510,000. A 180 is lower. So we're going to take a 180, okay, and then we subtract them. And now our remaining outside basis is going to be $330,000. So that's the way that we're going to work through a problem where there's a relief of where there's an assumption of liabilities from the partner who's taking it on from the partnership. Okay, so the problems that we've looked for previously in other videos was always the partnership was taking on additional liabilities. So we was trying to figure out what portion of those liabilities belong to that actual partner. Now we're looking at it from a different perspective. This is a distribution over to our partner. Because there's this distribution to our partner, right? Our partner's taking on the liability. So we have to deal with how much were they already liable for? So what was the net amount of new liabilities that they're taking? Add that to their existing basis and then subtract out the basis in the property that they received. That's going to give us our new outside basis. And we know that the basis that Madison has in that land is now going to be $180,000. And because it didn't exceed her outside basis or anything, there was no recognized gain or loss on this problem. All right, y'all, that's what I wanted to get through in terms of our operating distributions. I wanted to add that additional complexity to it. I will do a video that's going to relate to a liquidating distribution so we can finish off our focus on partnerships before starting to look over at S Corps. If this video has been helpful, please make sure you subscribe to my channel, like the video. If you have any questions, feel free to comment in the comments section.